Welcome everyone to this FinViz screening for option trades video. Today we're going to go through a little bit about how screening works. We're going to focus on FinViz and then we're going to match that up with option trades that make sense. And I think by the time we're done, you'll have enjoyed the process and learned some new things. So let's come over to FinViz and talk about their screener. As you log into FinViz, if you hit the All button, well, first of all, hit Screener right here, and then click on the All button. That will bring up fundamental and technical details. I like to do that just because, you might want to screen for some fundamentals. We're mostly going to focus on technicals. Now, the first thing we need to add is optionable and shortable. We can't trade options unless the stock is optionable, so I want that. I also want, usually for the stock price to be over $10. We're not interested in trading $2 per share entities, little penny stocks, anything that way. I also want average volume, and this I want to be high. I want to trade very liquid options. So by putting that over 2 million, that ensures that this stock I'm trading averages over 2 million stock shares per day. Finally, we get to price pattern. And from the pattern, this is where this video gets very interesting because I'm going to do patterns, but I'm going to do them the opposite of how they're traditionally taught. For example, some of the best buy candidates will be in your double top pattern. Now, a double top traditionally is taught as, well, it's a chart that's gone up and hit a high and turned down and then gone up and retested that high and maybe is turning down. And so you can start to see the M pattern. And they say M stands for murder, right? The stock's about to get murdered and it's going to come and it's going to break the neckline and it's going to surge below that and the selling pressure is going to intensify and oh boy, it's a big old problem. The problem is that most stocks in a double top pattern are not actually a double top. That's not what they are at all. Instead, the stock is in what looks like it could be a double top, and it ends up being a nice breakout pattern that you have stalled against resistance. And whether you want to call this a cup and handle, which is what I would call it, that's made famous by William O'Neill, right, years and years ago. He's the founder of Investors Business Daily, wrote a book, How to Make Money in Stocks. Whether you call that a cup and handle or whether you say this, it looks like an ascending triangle. See the ascending, it's ascending upward, but it's halted here against resistance. And then the breakout, it really doesn't matter how you see that pattern. The point is that most double tops aren't double tops. They don't stall there. They don't fail there. And so if I do the double top scan, I'm simply going to be looking for candidates that have that upside breakout momentum. Now, as we look through the charts, there's 33 stocks that pop up in these filters, right? Right now, today, there's 33 stocks. Some of these will be double tops. Most of them probably will not. So if I hit the charts button, it'll pull up various charts, and some of those are hard to see. Some of those are a little easier to see. So let's, if we zoom in, we could see them, but let's do it this way. I'm going to pull up a chart that's much easier to see and do you all a favor. Now, first, I'm going to pull up a candidate that doesn't look good. This is eBay, and this is one where I would say, okay, this looks like a double top. eBay was in the scan, and rightly so. You can see the M pattern. You can see that this thing gapped through. It never handled here. It just hit the resistance and blasted through. Here's your neckline. Notice as it plunged below, it gave the retest, what we call the kiss goodbye trade, retested back to old support, new resistance. I mean, this is an M pattern. This is a double top. Okay, have at it. Trade this to the downside. Great. It popped up in the scan, and it's right. That is a bearish candidate. But if we go back through some of these others, I'm going to take EQT, which is up near the highs, or I'm just kind of looking for stocks that are up maybe against those highs. That might be an example of what we're referring to here. EQT definitely fits the bill. Let's see if there's any others that would give us this same look and feel. TRP, is going to be 1. Twilio, TWLO. We'll go through those 3. Okay, now what do I mean by that? Here's EQT. Let's start there. So could this be a double top? It could be, right? This could be the left side of that pattern. So if we were to draw it out, this could be the big M pattern. It's possible, right? And then you turn down and away you go to the downside. Instead, I think this has a far more likelihood of being an ascending triangle. That this is actually something with strength, that it is ascending, pressured against the resistance, eventually will likely break out to the upside, and away we go. So EQT, bullish candidate. We also had TRP, so let's clear this out. It was popping up on the scan. Could this be a double top? It could be, but again, I think what we have here is a cup and handle. And this is one of my favorite price patterns for an upside trade. The way a cup and handle works is basically the size of the cup. The handle will usually be about 30% of that. So if we look at this and eyeball it and say, well, you've got some resistance up here around 55, you've got support at 49, the cup size is 6 points. What's 30% of 6? Well, that would be, if we pull out the calculator, you just take the $6, the 6 points that's in between resistance and support. That's the size of the cup, right? Times 0.3. The handle should be about $1.80 in size. So that means as we back off of 55, you go down to about 53.20. Boy, that's just about where that is. That's 53.27 is kind of the low there. See how that's handling in that. This is 30% of the size of this. That's exactly how it should go. And TRP, probably going to go and break out to the upside more times than not. Last but not least, we had Twilio that also looked, and I was looking for things that were basically up here closer to their resistance zones. And you can see that Twilio, does it have the possibility of being a double top? Sure, there's one peak. This is the subsequent retest, but again, I suspect that more times than not, this thing is ascending triangle and will come up and through this resistance zone. So, as we look at these candidates, we've got to decide which one do we like best for trading. How do we do a tiebreaker here? Well, Twilio and EQT, we'll take those two to start with. They're different companies within different sectors. So it really comes down to a question of which sector do we like best? Which sector out of these do we think has the most upside? Well, I can tell you right now that the financial sector looks pretty darn good. If we were to look at this from the standpoint of, its price performance, here's XLE, the energy sector, and look at XLE. Look at the energy sector ascending triangle itself, right? You can see the resistance, the support. See how it's above the short-term moving averages, 20 sloping upward, recent bullish crossover. So EQT looks pretty good because it's strong and its sector is strong. What about Twilio? Well, Twilio, now I'm familiar with EQT because I actually happen to own some EQT already. So let me just show you. It's actually one of the biggest natural gas producers in the world, and specifically here in the US. But if we were to look at this, so actually maybe the best way to do this, just hit profile, and it'll tell us the profile of the company and a little bit more. Here's the key executives, here's the sector over here. It says energy, industry, oil and gas, E&P, exploration, etc. So there's EQT, energy sector, like we talked about. If you don't know Twilio, you'd come in and punch in the symbol, you'd hit profile, and it will tell us what sector it's in. And it's in the technology sector, specifically software. Well, here's where the tiebreaker comes in. where energy looks strong. Let's zoom in here. Doesn't energy look great? Nice ascending triangle up above short-term moving averages, upward sloping. Boy, it's different with technology. Here's XLK, the energy, or pardon me, the technology sector, and it's a whole different ball game. You've got the 20-period moving average downward sloping. You've got the sector below both the 20 and 50. You've got a bearish crossover that just happened. You've got the sector up against that level as resistance. You have it making lower swing highs and lower swing lows, so it's zigging and zagging lower, whereas energy is zigging and zagging higher above its moving averages and so on. Well, that's the deal breaker. That's the tiebreaker. So we found two potential trades on the upside, but I would trust EQT a little bit more because the sector is stronger. And we want to swim with the tide. If you've ever been out in the ocean and you're swimming against it, it is exhausting and you can lose that battle. You don't want to lose that battle. You want to swim with the currents and, go with it, and it will just push you along and you don't even have to exert energy. And that's what we're looking for here. We want this sector that's heating up. We want inflow of capital that should be found in EQT, and away we go. Now, we've got to decide on trading strategy. So EQT, again, we could back out the chart. You could see the longer term, we're up at resistance. Shorter term, you can see the nice zigzag to the upside. You can see we're above upward sloping moving averages. Where do we think this can go? Well, we've scanned through. We found a good candidate with good prospects, with a good sector. Now we need to build a trade that makes sense. So in order to do that, we can use the volatility of this stock that we're trading. So we come over to EQT. We'll pull it up in Trader Workstation. Here's the stock. Pull up its options. Maybe we're going to trade a strategy into December monthly expiration. With the stock at 60, I can see what the at-the-money call and at-the-money put values are going for and add them together. Why do I add them together? Well, $2 and $1.40, right? Here's $2. Here's $1.40. That's the at-the-money straddle equals $3.40. Why is that important, what the at-the-money straddle is going for? Here's why. The options market is incredibly smart. And if it's pricing the at-the-money straddle at $3.40, it's giving you its expected price range between now and the expiration you're analyzing. So it's fair for me to say that between now and December 19th, the following. Let me close this down now and say here is the probability cone. So here's December 19th out in time. And the at-the-money straddle is trading for $3.40. So if I take the current stock price, I can add the at-the-money straddle value to it, and I can subtract the at-the-money straddle value from it. And that will give me the probability range, the probability cone between now and the expiration we were looking at, because these December 19th options have everything of note priced into them. Everything that's known. If this company reports earnings, if there's a Fed meeting, if there's this or that, they're priced into the options. So this is the expected price range. Well, 640 minus 340, 6040 minus 340 is $57 per share. That's the low end of the range. 640 plus 340, that is 6380. That's the upper end of the range, and this is a one standard deviation probability cone. 68% probability that we end up inside of that range. Why is this helpful? If I'm putting on a trade to December 19th, does it make sense for me to target a move to 65? No. Does it make sense to target a move to $68 per share? No. Not if I believe this probability cone. Now, if you were extremely bullish, if you're out of your mind bullish, if you think this is just going to go on a tear and that the options market is wrong and mispricing volatility and so on, I suppose you could put on that trade. But normally we want to use this expected price range, the volatility priced into the options, to give us a sense of target. So for me, I'd maybe be targeting a move up to 63 per share if I were bullish, or maybe a move down towards 57-ish per share. Could I target 64? Yeah, that's close enough, but somewhere up in that range, right? So now as we build a spread, I'm going to have 63.80 in mind as my upper target. For example, if I come into my spread and I build one, and we choose our strike prices, we might buy a call spread. Well, maybe I'll buy a 60 and sell a 63 or a 64. Let's sell the 63. And we could build that together as one structure, right? We can build a combo, build a vertical spread, December 19th call combo, buy the 60, sell the 63. And here we've got a trade, a structure that if we buy this spread, we are spending at the midpoint. See the columns here. This is your bid column. This is your midpoint. This is your ask column. So the midpoint, the mid value is about right there. We could probably get a little better price than the 122. Maybe we can get filled at $1.20. That means that we can put on a trade structured for EQT to go higher. We're only risking $120 per spread. Because it's a $3 wide spread, we can make 3 minus 120. That's 180 max profit. So it's about a 1.5 to 1 reward to risk ratio. Our reward potential is 1.5 times the size of the risk. Good structure, good probability. We're using the probability cone. We're inside of that. We know that the stock is likely to be bullish, cup and handles, ascending triangles, the things we want to see for some upside push. We've got a strong sector. We did all of this in less than 20 minutes, at live in class. So that's a good example of how you can scan, screen, and look for option strategies. So now, most importantly, make sure you hit that subscribe button so that when videos like this come out, you're able to access them, take your trading, your knowledge to another level. I hope you find it fun, enjoyable, and enlightening as you go through these videos. Hit that subscribe button to learn more. Visit us at mavericktrading.com, and we will see you on the inside. Goodbye, everyone.